What's going on, everyone? My name is John with Valiant Mortar and I'm an economist. Today we're talking business ownership. Hit that subscribe button if you want to build a stronger financial foundation through saving, investing, and productive ownership. In the last video, we compared high-yield savings accounts, money market funds, and treasury bills. That was fundamentally a conversation about protection. Where can you keep your emergency fund? Where can you store cash that may be needed soon? And how can that money earn something without exposing it to unnecessary volatility? But once you build that layer of protection, another question eventually appears. What are you protecting the money for? Some of it may support your household. Some may be eventually invested in stocks, ETFs, or real estate. But there's another productive asset that most people often overlook because it sounds either too intimidating or too glamorous. A business. Business ownership doesn't mean you need to quit your job tomorrow, invent the next major technology company, or put your savings on a roulette table. It means understanding how ownership changes your economic position and then deciding whether some version of it belongs in your long-term blueprint. The important question isn't whether everybody should become an entrepreneur. The question is, what changes when you own the system producing the income instead of only receiving a payment from it? Employment can be one of the most valuable parts of your financial infrastructure. A good job may provide predictable income, training, health insurance, retirement contributions, professional relationships, and capital that can later be invested. So this isn't an employee versus owner argument. It's an explanation of how the economics differ. When you're an employee, you generally agree to provide a certain combination of time, judgment, knowledge, or physical labor in exchange for compensation. You might earn a salary, an hourly wage, bonuses, or a commission. If you become more productive, you may negotiate a raise or pursue a better opportunity. But the basic transaction remains the same. The organization owns the operating system and you receive an agreed portion of the value created inside it. However, an owner stands in a different position. After customers pay the business, the company must pay suppliers, employees, rent, software, insurance, interest, taxes, repairs, and every other legitimate expense. Whatever remains may be reinvested, distributed to the owner or owners, reserved for future problems, or used to reduce debt. The business develops durable customers, useful systems, dependable cash flow, valuable assets, or a strong reputation. The ownership interest itself may eventually have value. That creates a second financial dimension. The owner may receive cash flow today and hold equity that could become more valuable tomorrow. But neither outcome is guaranteed. In fact, the owner may receive nothing after everybody else gets paid. That's the trade-off. Potentially more upside, but far less certainty. There's a useful parallel in the 1999 movie The Matrix. Neo, the main character, begins in a familiar office environment, but he senses that the world he sees isn't the whole system. His journey forces him to recognize the hidden structure controlling what happens around him. Business ownership can create a much less dramatic version of that shift in financial thinking. You start seeing the economic code underneath an ordinary transaction. A customer doesn't merely just pay $100. You start asking, how much did it cost to acquire that customer? What did the product or service cost to deliver? How many hours of labor were required? How much cash must stay inside the company? And will this customer return? And Can somebody other than the owner perform the work? The objective isn't to escape employment or society, it's to understand the systems through which money, risk, labor, and ownership move. Once you see that structure, you can make much more deliberate choices, even if you decide that starting a company isn't the right move for you. It helps to think of business ownership as a progression rather than one giant leap. Level 1 is selling your time. That includes traditional employment, but it can also include contract work. Your income is closely tied to the hours, projects, or responsibilities you personally handle. Level 2 is owning your job. Imagine a self-employed photographer, consultant, landscaper, barber, or mechanic. The person owns the operation, controls the customer relationships, and may earn more than an employee in the same trade. But when the owner stops working, most of the revenue may stop too. That's ownership. But the owner remains the central operating component. Level 3 is owning a system. The business has repeatable processes. Customers can be served by trained employees, contractors, software, equipment, or documented procedures. The owner still matters, but the business no longer depends on every hour of the owner's labor. Level 4 is owning an asset. The company can produce cash flow with professional management and may be transferable to another buyer. That doesn't make it passive or risk-free. It means the operation has become something more than an extension of one person's job. A lot of people become frustrated because they expect to jump directly from employee to level 4. In reality, they may spend years building skills, customer relationships, operating procedures, and financial reserves. That progression isn't failure, it's the work required to convert personal effort into a durable asset. Now, there's a distinction that we have to make. It's that revenue isn't owner wealth. Suppose somebody starts a mobile detailing business and reaches $8,000 in monthly revenue. That sounds impressive, but let's examine the code underneath it. Assume chemicals, fuel, payment fees, and other direct costs total $1,800. Vehicle expenses, insurance, software, advertising, and equipment replacement add another $1,700. The business now has $4,500 remaining, but the owner also worked 120 hours during the month. If equivalent labor should be compensated at $25 per hour, that work represents $3,000 of economic cost. Now, the business has approximately $1,500 remaining before taxes and other potential obligations. That $1,500 is much closer to the return on ownership. The other $3,000 primarily compensated the owner for doing the job. This distinction matters because revenue can create excitement while disguising a weak business. Even accounting profit can mislead you when the owner's unpaid labor, future equipment needs, customer concentration, or working capital requirements aren't properly considered. A business becomes financially powerful when it can compensate the people performing the work, maintain its operations, withstand setbacks, and still produce attractive returns on the owner's capital. On Nipsey Hussle's 2018 song, Hustle and Motivate, he says, I took control of things, balling the soul away. And later he says, ain't really trip on the credit, I just pay all of my dues. Those ideas belong together. Ownership can give you more control over pricing, strategy, hiring, customer selection, capital allocation, and the direction of the organization. But control doesn't remove obligations. It makes you responsible for them. The customer still needs to receive value. Employees and contractors need to be paid. Suppliers have deadlines. Equipment breaks. Taxes and filings don't disappear because sales were disappointing. And sometimes the owner gets paid last or doesn't get paid at all. Business ownership raises the potential ceiling partly because the owner accepts uncertainty that other participants are being paid to avoid. That doesn't make the owner morally superior. It means the owner holds a different bundle of risk, responsibility, and potential reward. According to the Federal Reserve's most recent completed survey of consumer finances, 20% of U.S. families owned a privately held business in 2022, which was the highest share recorded in the modern survey at that time. That doesn't tell us every business was profitable or valuable. It tells us that private business ownership is a meaningful part of household economic life, not an unusual path reserved only for major founders. But businesses are concentrated assets. Your income, savings, debt, professional reputation, and time may all become tied to one company, one location, one industry, or a relatively small number of customers. Public market investors can buy hundreds or thousands of companies through an ETF. A small business owner, however, may have most of his or her financial future concentrated in one operation, and business closures are normal. Bureau of Labor Statistics data shows that only 34.7% of private sector establishments created in March 2013 were still operating in March 2023. The data tracked establishments rather than every possible definition of an individual entrepreneur, but the message is still important. Durability can't be assumed. The possibility of building wealth is real. So is the possibility of losing capital, time, and income. The rational response isn't to avoid every risk. It's to structure the experiment so one failed idea doesn't destroy the household. So, before committing meaningful money, ask yourself 5 questions. Question number 1. What painful problem are you solving? A business doesn't begin with a logo, an LLC, or a social media account. It begins with a customer willing to pay for a result. Who has the problem? How are they solving it right now? And why would they switch? Question 2 is, do the unit economics work? After the direct cost of delivering one additional sale, how much money remains? That remaining amount must eventually support overhead, owner compensation, taxes, reinvestment, and profit. Question 3 is, how much cash could the experiment consume? Separate household liquidity from business risk capital. Your emergency fund protects your mortgage or rent, groceries, insurance, utilities, and other essential obligations you may have. It isn't automatically startup capital, however, merely because it's sitting in cash. Set a maximum amount you're willing to lose before enthusiasm takes over. Question 4 is, can the work become repeatable? Can the process be documented? Can another person reasonably learn it? Can customers return without being persuaded from zero every month? Repeatability is what begins turning labor into a system. And last but not least, question number 5 is, does the opportunity fit your actual life? A theoretically attractive company may still be a bad fit for your time, family, responsibilities, temperament, skills, health, or financial position. There's no price for owning the wrong business. So if all that sounds interesting to you, you can actually perform your first ownership experiment. You don't need to begin with a lease, employees, or 6 figures of borrowed money. Start with evidence. First, identify one specific problem connected to skills or knowledge you already possess. Second, speak with at least 10 potential customers, but don't ask whether they like the idea. Ask how they handle the problem today, what frustrates them, and whether they've already paid for a solution. Third, create a simple paid pilot. Not a perfect brand, not an elaborate website, a clear offer with a defined result, price, and delivery process. Fourth, cap the downside. Decide in advance how much money and time you'll commit before reviewing the evidence. And fifth, measure the economics. These are leads, conversion rate, average sale, direct cost, hours required, and cash remaining after fairly valuing your labor. The Small Business Administration, or SBA, similarly places market research, business planning, startup cost analysis, funding, and legal structure among the early steps in developing a business. The structure selected can affect taxes, registration requirements, operations, and legal liability, so that decision may require qualified legal and tax guidance. Your first objective isn't to call yourself a founder. It's to obtain enough real evidence to decide whether the opportunity deserves more capital and time. So in conclusion, cash gives you stability. A diversified investment portfolio gives you participation in business and assets that other people operate. Direct business ownership, however, gives you the opportunity to influence the system itself. That control can raise your financial ceiling, but it also removes part of the floor. Revenue may be uncertain. Capital can be lost. Your time may be consumed. And unlike a diversified ETF, your wealth may become concentrated in just one operation. That's why the order matters. First, build financial stability, then develop useful skills. Test demand before making a major commitment. Separate your household reserves from business risk capital, and only scale when the evidence, not your excitement, supports the decision. So for your next step, write down one problem that people already ask you to help solve. Then identify who pays to solve it today and what the current solution gets wrong. And subscribe, because we're going to continue this series by comparing 3 paths: starting a business, buying an existing business, and owning companies as a passive investor. And if your emergency fund still needs a proper home, watch my video, Where to Keep Your Cash in 2026, High Yield Savings Account versus Money Market versus Treasury Bills next. It should appear on screen in a few seconds. In the comments, would you rather start a business, buy one, or remain a passive investor, and why? This has been John with Value and Mortar, signing off.